think you can think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market.
Fed Chair Jerome Powell there calling the quarter-point cut risk management. The first reduction of the year follows a significant slowdown in job growth and unprecedented political pressure from the Trump administration. Live from Sydney, this is Insight. We dive deeper into the stories that matter with crucial context and sharp analysis. Well, US equity futures advance after the Fed's cut, but questions linger over the pace of future policy easing. And the Fed's combination of a dovish move with cautious guidance have left investors conflicted. We're going to speak with Indosuez Wealth Management CIO Alexandre Drabowicz. The CEO of Trip.com is going to join us on the Chinese government's plans to boost consumption by focusing on services, and we'll get more on the impact that that's going to have on travel. Also ahead, China bans its tech companies from using the AI chip Nvidia made just for them. The move extending the euphoria around domestic players, especially Baidu and SMIC. Also, Indonesia's central bank goes all in on growth with a surprise rate cut that's also raising concerns over its independence. Here's a look at the Asia trading session after that Fed cut. That was the first cut we've seen this year. The 25 basis point cut coming as the US jobs market shows growing signs of weakness and as Chair Jerome Powell endures months of political pressure from President Trump. Now, the lone dissenter at that meeting, there was only one. It was, well, Stephen Myron, the Trump advisor who was just appointed this week, and he pushed for a deeper half-point cut. Well, our guests have also been weighing in on the Fed decision as well as Powell's comments and on the outlook for the labour market and inflation.
This is an insurance rate cut. That's all it is. And it doesn't really foreshadow what's going to happen going forward.
It's a relief to the stock market because it could have been way more hawkish.
I don't want to be overly dovish on here because, you know, we are in a stagflationary world. The supply of labor being more of a drag, but if it ultimately flows through to the demand side weakening, then you're going to see even lower rates across the curve.
There's not a lot that their interest rates policy can do about these tariffs. It's too early to actually become accommodative. So I think they know where the end point is, and they're trying to sort of come up with the right language to sort of tell us that that's where they're going to go.
Well, our next guest expects one more Fed rate cut. That's going to be in December, then two more next year. And that's a lot less than the 6 that's being priced in by the markets. Let's get some insights now from Alexandre Drabowicz, Global CIO of Indosuez Wealth Management, which manages $250 billion in assets. Alexandre, thanks so much for joining us today. And I just want to start by inviting you to add your voice to that chorus. We got 25 basis points. That's pretty much as everybody was expected. But there's still a note of caution there from Jay Powell, particularly around inflation. Do you share those concerns?
Thank you, Paul, and good morning. I will highlight actually 3 key takeaways for me from this FOMC meeting overnight. The first one is there is a lot of unity behind this rate cut. So I think there's a clear message that Powell managed to get everyone on his side to show the clear independence from the Fed. Naturally, Moynihan only dissented for 50 basis points. The second 2 key takeaway here is that behind the dovish plots, because yes, indeed, the market or the Fed is expecting another 2 cuts, there's a lot of dispersion. We are 3 months away from the end of the year. We only have 2 meetings. You have 6 members looking for no cuts, 9 members looking for 2 cuts. There's 1 member looking for 5 and 1 looking for a rate hike. So this is quite unusual with so little time before the end of the year to see this dispersion. So we are still looking ourselves for 1 additional cut. Could be 2, could be 1. I think how this is going to be managed over the next 6 months will depend also on the future path of inflation. And importantly, the third point is that when you look at the Fed projections, for me, there's a kind of a hawkish twist. Powell actually revised slightly growth up, It doesn't change unemployment expectation, and even inflation is going up. So all in all, if I would actually summarize what Powell said, it's risk management. For me, it's really recession risk management.
Yeah, and some of those questions also being raised around the jobs market, in Jay Powell's words, no longer very solid. So what's your outlook for the jobs market as well? And can you tell us a little bit more about how you view recession risk in the US?
Well, I think the economy is cooling in the US, that's for sure, but it's not cold. Indeed, the job revisions have been significant. We also know that immigration in the US has ticked down, so it means that the unemployment rate actually is getting stable, and the job creation, which was estimated to be necessary to 150,000 a month earlier, is probably closer to 70,000. But when we look at forward-looking data, and I'm thinking more at high-frequency data, whether it's temporary staff hiring, whether it's retail sales that we recently seen, or credit card data, they are actually looking pretty good. So from our point of view, the U.S. consumer remains resilient for now. Yes, the unemployment rate can tick up a little bit, but we don't see a collapse. The hiring rate is slowing for sure, but the layoff rate is not ticking up. So there is some comfort on that side. And you look at GDP, final point. GDP is tracking at 3.2% actually for the third quarter. It's very, very far away from any recession risks.
Yeah, I mean, you do describe, and some of our other commentators have pointed this out as well, that the U.S. economy is in reasonably good shape. Is this one of the reasons that you don't expect to see quite so many rate cut reductions as some of the other commentators?
Yeah, absolutely. At the end of the day, we are aligned with basically what the Fed is expecting, which is, to bring down rates to about 3.5%. It will have actually to see a significant deterioration in the employment situation to actually go for further cuts. But I think the key risk for our projections today is how the new members of the Fed are going to look like. So we know that the new members that are going to come on board are going to be certainly much more dovish. Now, is that going to be enough to convince all of the members to be much more dovish? That's going to be the key question for 2026 and the risk to our call for only an additional 3 cuts.
Well, we got a new set of dots as well. It was kind of interesting also that there was just the one dissent, unsurprisingly, it was Stephen Meyer, the new member. But when you're looking at the dot plot, thinking about some of the commentary from the chair, Jay Powell, has that led you to change any of your allocations, or do you feel like your expectations heading into that meeting were pretty much vindicated?
No, pretty much as expected. At least the Fed didn't signal any hawkish message, and I think the market had high expectations coming into this meeting. So maybe Powell is trying to manage expectations, but he doesn't want to go against expectations. So we remain actually overall constructive on equities, and we have been so for quite some time from the second quarter. We do admit that there are some areas of valuations that are maybe a bit expensive in the US, so we are playing more the broadening of this equity market, really, particularly on the small cap segment, which has been frustrating, to be fair, in the first half of the year. But with these expectations of rate cuts in the past 3 months, actually small caps have started really to catch up significantly, and we believe there is additional catch-up possible on small caps in the US.
And how about emerging markets as well? Because 6 months ago you expressed that you quite liked emerging markets. Is that a view you still hold? And in particular, through the lens of the surprise rate cut we got in Indonesia as well?
Absolutely. So emerging markets have been a key conviction. Remember that we already changed our view on China back in October and had a much more positive stance on China and the rest of Asia. We have actually recently reinforced this emerging markets conviction over the summer, where we had been over the first half of the year a bit more overweight onto European equities, and we have decided to reallocate capital to emerging markets. And by the way, year to date, emerging markets have basically recorded twice the return of the S&P 500. I'm actually struck when I come to Asia, and I was a couple of days in Hong Kong and now in Singapore, that the mood has totally changed. There is a lot of liquidity in this market. Clients are much more optimistic, and we have this diffusion of artificial intelligence coming to AI, potentially because in the US it's expensive and investors are looking basically to get more exposure to the AI theme in Asia. So we believe there is still a significant potential on emerging markets. Valuations are not expensive at all compared to the US. You also have tailwinds because the US dollar is weaker, and that's good for emerging markets in general. And overall, we believe that investors continue to under-own emerging market equities.
Well, before we let you go, Alexandre, we have one more major rate decision coming up this week. It is, of course, the Bank of Japan. We're not expecting to see any change there, but in your view, where is the bar for further tightening?
Well, I'm not sure if the Bank of Japan actually knows. They've been trying basically to raise rates for the past 12 months and have been unable to do so. We have some political issue when Ishiba-san actually also resigned. The economic situation is still, quite weak. We know the government is also trying to, again, do some fiscal stimulus. So it's kind of a weird situation from the Bank of Japan. Real rates are extremely negative, but at the same time, you need to support the economy. They also have to be mindful of the bond market. As this year, the 20-year and 30-year JGB yield has risen significantly. So maybe the topic for a rate hike is somewhere in the course of 2026, where you will have probably to raise rates by 1 or 2/4 of a point. But I think the main focus right now is more the bond market. They attempted to taper the JGB bond purchases, and they can see that the steepening in the yield curve can actually put pressure on the economy. Maybe at some stage you will have to do some yield curve control again. So no rate hike this week, a topic for 2026.
All right, Alexandre Drabowicz, Global CIO of Indosuez Wealth Management. Thank you so much for joining us today. Still to come on Insights, our conversation with the Trip.com CEO as authorities in a Chinese province order it to fix allegedly unfair practices in its merchant pricing. Jane Soon joins us exclusively next. This is Bloomberg.
We will systematically expand the scope of unilateral visa-free entry countries, optimize and improve regional entry visa-free policies, leverage my country's advantages in traditional cultural resources, and attract more overseas people to travel in China and buy in China.
As Chinese Vice Minister of Commerce Shun Qiuping talking about the country's new measures to stimulate domestic demand. Well, travel-related stocks are getting a boost this week thanks to Beijing's new measures. Analysts say the move may drive better sentiment in the near term. If we take a look at how travel stocks have been performing this week, pretty well. We've got Air China up by 1.6%. Yunnan Tourism, a huge gain there, 25%. And Trip.com also having a pretty good session over the past week, 6.3% gain. And joining us now exclusively is Jane Soon, CEO of Trip.com Group. Jane, thanks so much for your time today. I just want to start with a look back on those second quarter results. A pretty healthy spike in revenue, about 16% there. Where do you see the stronger travel demand coming from?
Yeah, we have seen strong demand in international business. We have been working very hard to bring customers from Asia to the rest of the world, and also inviting people all around the world into Asia.
So if you look at outbound hotels, air bookings as well, they're getting above pre-COVID levels now. How helpful is this consumption stimulus going to be in China towards keeping that momentum up?
Definitely. So compared to the outbound travel business, we have already exceeded 2019 level at 120 to 130% compared to pre-COVID level. And inbound level, because all the governments are very proactive in giving incentives for global customers into their own country. We work with all the regional government to make sure we bring high quality of the customers to these beautiful travel destinations. So we're very positive on the movement.
Do you have any broader concerns, though, about consumption growth in China? Because it has been very tepid. What are the risks for you going forward?
Certain sectors might have some pressure, such as real estate market. But if you ask the young people if they are not buying houses or apartment, after COVID, the number one spending is travel. Number two is wellness. Number three is events, such as concerts, music festivals. So we are very positive for the development in the travel industry.
Is that where you see the greatest opportunity for growth in that youth demographic?
Yes, we have seen the trends which we called 3 E's. The first E is events plus travel. That is more tailored for youth growth. Young people like to watch Taylor Swift shows, want to attend F1 car races, NBA basketball game. So we normally do a package centered around these major events. The second E is elderly friendly. People who get retired, who wants to go abroad to explore the world. We also want to make sure we have elderly-friendly product for that segment. The third one is emerging market. During the lunar year calendar, Australia, New Zealand, and South Africa become the top 3 travel destinations. And in the summer, Iceland, Norway become very fast-growing travel destinations for Asian customers.
You mentioned there under the first E heading that packages still remain a large part of the business, but Bloomberg has been writing about how travel preferences are starting to shift away from package bookings, group tours as well, more towards consumers just booking their own flights, booking their own accommodation and excursions, etc. Is this a trend you notice as well, and do you see it taking hold?
Yes, this is the trend we're leading, and we have customized tour and private tour for our high-end customers. For example, if a customer is booking a flight, a business class or first class flight from Tokyo to London, we'll push a 5-star hotel such as Four Seasons to the customer, and then we'll recommend Michelin restaurants to the customer, and also make arrangement for a very nice show, a museum visit during the stay. So this one-stop shopping platform we have offers very comprehensive products for our consumers.
You mentioned a moment ago that depending on seasonal demand, you see a lot of demand for destinations such as Australia, New Zealand, South Africa, and in the other months, Northern Europe. But how about Asian destinations as well? What sort of trends are you noticing there? And I'm asking in particular about Thailand, which saw a bit of pullback over safety concerns. Is that starting to turn around?
In Asia, more than 60% of the customers in Asia travel within Asia. So Japan, Thailand historically have always been very popular. Singapore, Malaysia are also very popular for travel destinations. Japan, because of the reasonable currency, it attracts customers in the past 2 to 3 years. And Thailand historically provide a very comprehensive product offering from high-end, middle-range, and low-end. So historically, it's also a very popular travel destination. We're working very hard with different government, their travel bureaus, to make sure we can highlight the best attractions for these destinations and bring the right customers to their countries.
And how about those safety concerns in Thailand? What have you heard from the Thai government in terms of addressing that? And do you feel it's going to be enough to reassure travellers?
I think every country will have ups and downs. In our business, there are lots of uncontrollable events, such as earthquake, tsunami, and sometimes the safety is also very important. We always work with the government to make sure they put the right measures to make sure travelers feel safe when they travel into these travel destinations.
I wonder if you can tell us a little bit more about inbound travel to China as well, because we saw that surge in your results in the second quarter, although, to be fair, coming off a very low base. Who's coming into China now, and what's the difference between the trends you're seeing now and what you saw pre-pandemic?
There are more than 57 countries which are given free visa, and also for in-transit visa, the government also extended from 3-day in-transit visa to 10 days. So it's much easier to travel into China. And also, when we host the global partners meeting there, lots of global partners told us the country is very safe. It's when you walk in the midnight, they feel very safe, particularly for women travelers. And then the history is very rich. The high-speed railway are very advanced. And on top of it, it's affordable luxury. The hotel price is very reasonable. If you pay $100 to $200, you can stay in a very nice 5-star hotel with excellent services. So these are the feedback we got. So we have seen very significant pickup for inbound travel into China.
I just wonder also if you can tell us a little bit about what you've seen of the impact of AI on the travel industry as well. Can you unpack some of the opportunities and the challenges there?
Sure. We have already seen results in 4 areas. The first one is user interface, because in the past we need to do search. For example, I need a 5-star hotel, kids-friendly with a swimming pool, and then the search engine will come up with the right hotels. Right now, you can have a conversation with our Trip Genie, and it will come up with the right result. The second one is with coding. We can increase the efficiency using Copilot, so the productivity can be enhanced. And the third one is the user's customer service level is being enhanced because our customer rep will be able to make tailor-made products for our consumers. And lastly is the content generation. Using AI, we can have more videos and audios and content much more efficiently for our customers. So those are the areas which we already have seen great results. And as the technology is progressing, we'll be able to see more and more areas which can be fully utilizing AI to empower customers' users' experience.
Yeah, Jane, before we let you go, I do have to ask, I wouldn't be doing my job if I didn't. You've been summoned by market regulators in Zhengzhou over violations of e-commerce laws. I know you haven't been briefed, but can you give us a reaction to that?
Sure. We are very committed working with different agents to stay in compliance and support our customer-centric philosophy.
All right, Jane Soon, CEO of Trip.com Group, thanks so much for joining us. Still to come, Morningstar's Director of Asia Equity Research going to be joining us to discuss the outlook for China's tech giants with a push for homegrown AI chips in focus. Lorraine Tan joins us next. This is Bloomberg. Welcome back. You're watching Insights. China is widening its clampdown on Nvidia, instructing domestic companies to halt orders for a particular workstation chip that can be repurposed for AI uses. And this is Beijing's latest step, pushing Chinese tech firms to move off Nvidia hardware and pivot to domestic alternatives, even as China also protests U.S. export curbs. For a closer look, let's get to Bloomberg Intelligence senior analyst Robert Lee. Robert, what can you tell us about this particular chip, the RTX Pro 600D. What do you make of this latest development to discourage Chinese companies from using it? It was developed for them after all.
Yeah, I think in your sort of excellent intro, you've said a lot of it already. But, I mean, this is another development in the ongoing saga. Taking a step back from the news and headlines, China is gunning to be self-sufficient in tech for a number of reasons. Again, from a Chinese perspective, the US is an unreliable supplier. It's an unreliable partner. That's one motivation to drive towards self-sufficiency, particularly in semiconductors. And then secondly, in terms of economic development, China is increasingly looking to the high-tech sector to drive its GDP growth over the coming years. So our excellent economists at Bloomberg Economics have written reams on that subject. So what we heard, and this is an unconfirmed story, I must stress, is that the regulator in China, again, is instructing the likes of Alibaba and Baidu to reject this RTX Pro 6000D, if I can get the name right, which is basically a lower spec chip versus Nvidia's H20, and push them towards domestic supplies. So it's another headline in this ongoing saga. Ultimately, China will push for complete self-sufficiency on the AI accelerator side. So that raises, again, large question marks and uncertainty for Nvidia and the opportunity or lack of opportunity they're likely to see in China in the long run.
Yeah, I mistakenly called it the 600D, left off a zero, so I throttled it back even more by accident. But I wonder if you can tell us about this huge rally that we've seen in China's tech sector. Does it got firm foundations, in your opinion, or is it looking a bit overcooked?
Okay, well, as you know, Paul, there's a high retail contingent in most Asian markets, Hong Kong and China in particular. We're heading towards a big holiday here, the Mid-Autumn Festival, which is next month. So I think we typically see, a degree of enthusiasm and ebullience. But why are investors, really buying into China tech shares? Well, as I said, if China's pushing towards self-sufficiency, again, that may well drive growth within the chip sector domestically in the long run. But, back to reality, back to the actual earnings numbers, not picking on these companies, but Alibaba and Baidu earnings estimates, based on consensus numbers, have both been heavily downgraded this year. If you look at Baidu in particular, and so I just need to look at my paper, based on consensus, Baidu's net income is going to decline nearly 30% this year and only grow 7% this year. That's assuming that consensus numbers sort of stay where they are. So really, investors are, I think, more chasing headlines, they're more chasing hype. It's not reflected by the reality on the ground and the fundamental earnings outlook for these businesses. So I think that creates a pretty high-risk environment.
Yeah, to your point, while you were speaking there, we were seeing some of those big tech names, how they've performed over the year. Cambricon, for one, up 123%. I think the company's even issued its own warning about that. Do you think we're approaching bubble territory?
Well, again, I think that the biggest issue for me is this huge divergence between the hype and the headlines and the reality on the ground. I think we're not seeing the earnings upgrades coming through. On the contrary, we're actually seeing earnings estimates downgraded for many of the leading companies. So I think, ultimately, we need to either see earnings come through. I think that's highly unlikely, given the ongoing monetization challenges in the China AI sector. So really, again, I think that creates quite a high-risk, dangerous environment. I think as well the backdrop of Fed rate cuts has obviously driven sentiment towards high-beta tech stocks. So, there's a risk of profit-taking, but I think more than that, yes, there are fundamental questions about the sustainability of this rally because we're just not seeing the earnings upgrades coming through.
All right, Bloomberg Intelligence senior analyst Robert Lee there in Hong Kong. Well, joining us now is Lorraine Tan, Director of Equity Research at Morningstar. Lorraine, I just want to pick up on some of the points that Robert was making. I mean, we're seeing a huge run-up in China tech stocks at the moment, a lot of excitement over AI, cloud-driven growth activity as well. Realistically, how much more upside is here?
Well, basically, I think to be honest, these companies have been sold down tremendously over the past few years. So they were trading on relatively cheap valuation. And so we did have buy calls on the three companies, Baidu, Alibaba, and Tencent. And with the recent run-up, both Baidu and Alibaba are in what we would call as fairly valued territory. But so we still have a preference for Tencent in terms of upside. Having said that, I think the benefits we think from the current AI push particularly from Baidu's angle, is more on a cost containment basis. As you mentioned, there's still a lot of question marks as to whether the chips can be sold, how much earnings they can make from the monetization of AI, etc. I think for Alibaba, the situation is a bit clearer. They are a leader in the cloud space in China. So we do see strong growth of revenue coming from the cloud infrastructure activities for them and services as well to lead Alibaba's earnings growth. Both these companies will see sluggish growth for the near term. So the pickup is basically in about, from in about 2 to 3 years' time.
I just want to get across some breaking news, which is perfect timing, really. We've just heard from Huawei, which has unveiled a new AI chip, which it says is going to rival Nvidia. So this is a new lineup of AI chips over the next 3 years. They're called the Ascend 950PR, the Ascend 950DT, and the 960 and 970 as well. So Huawei pushing ahead strongly in the chip space to compete with Nvidia. Is this why Chinese authorities are encouraging their tech companies to say no to the Nvidia chip that's been created specifically for them? Or is there some other broader political game at foot here?
I think there's probably a little bit of both that's going on. And you've mentioned it previously very nicely that, if you look at things, what the U.S. is trying to do is to slow the pace of development down on the chip space in China. So from the Chinese perspective, you might as well go domestic if that's the case. So there's a little bit of both. Having said that, we're pretty skeptical that anything homegrown can completely basically substitute Nvidia at this stage. We do still feel that the U.S. chips are still a couple of generations ahead at this point, given that Nvidia can only sell the lower grade products in China. Having said that, there's still, I think, the size and the capacity that Nvidia is producing for China is going to be a little bit hard to completely offset in the short term. So yes, we're still probably a few years out from having that sort of ban, comes through. Absolute ban sort of be imposed realistically. So I think there is a little bit of a negotiation tactics that's going on here. Having said that, obviously there's a lot of speculation going on at the moment, and we'll believe it when the companies actually do say that they're going all domestic.
I just wonder if we can get some of your calls as well on particularly Baidu and Alibaba. You talked about Tencent there, but what's your price target outlook for those two?
Yeah, so our fair value for Baidu is 143 for the Hong Kong shares. For Alibaba, it's 175. And for Tencent, it's 800. We do have a preference for Tencent at this stage because we still see upside. The growth in Tencent, earnings growth over the near term is going to outpace that of Baidu and Alibaba. Baidu, for example, is basically still facing difficulties and challenges in its ad revenue. Alibaba, obviously, the e-commerce side is very mature. It's obviously in battling a intense competition on the food delivery space as well. For Tencent, we're seeing a bit of a better broad-based growth, and therefore we think that's a safer, or rather more attractive near-term bet.
We've got all of China's big tech companies on something of a spending spree at the moment. How sustainable do you consider the spending to be? What it's being used for? Do you have any concerns about rising costs here?
On the contrary, what we've seen in the recent earnings was that the cost containment was actually surprisingly positive relative to our expectations. A lot of that is actually coming from their internal AI efforts to contain costs. So that's where we actually see the margin improvements coming through in the short term. They are spending a lot of money.
All right, we appear to have lost Lorraine's audio there, but we'll have to leave it there. That's Lorraine Tan, Director of Equity Research at Morningstar. Still to come, Indonesia's central bank surprises economists and markets with a 25 basis point rate cut after pressure from President Prabowo. TBS Bank's Radhika Rao joins us next for analysis of what they're calling an all-in pro-growth push. This is Bloomberg. Weakness in the US jobs market was highlighted as a key concern for the Fed after their quarter-point rate cut. Ahead of the decision, Bloomberg spoke exclusively with Bank of America Chairman and CEO Brian Moynihan about the challenges employers are facing.
If you think of 23 summer, the Great Resignation, it was very tight. Then it loosened up, and it's more imbalanced now. So our turnover rate in our company is running about 8%. Even in places like tech programmers, of which we have 30, 40,000 of them, we're running in double digits is now in 3-4%. And what that shows you, the bid in the market's different, which then shows you people are being more careful at headcount. And you heard some of my colleagues talk to you about that. So I think the unemployment rate is still low, but I think businesses are being much more careful in managing their headcount for a number of reasons. One is to get by understanding how all the policies are coming at them fit together. I'm talking about U.S. businesses mainly. And then secondly, they're also making sure that they're careful, and I heard some of my colleagues talk to you about this earlier. As you think about this application of technology, we know what this does. We have half as many people working in consumer business than we did a decade plus ago. We have half as many people working in operations. We know that as these technologies can apply to our legal department, our finance department, under Alistair, our risk department teammates, we know that if we manage the headcount carefully, we will do it. So we look at headcount very carefully and say, don't hire people unless you really need them. Not because we're trying to save money, because frankly, from a human management capabilities, we don't want to have people who won't be able to have a career here. So we just hired 2,000 plus kids from school. So we brought in all those new talent. We'll hire these 10,000 veterans. We'll hire these 8,000 people from community college. But each month we get the right to make a decision on whether we're going to hire about 1,300 to 1,500 people, and we're just managing that very carefully. So I think we're an example of what's going on in the broader labor market. You heard Wendy and my colleagues talk about it. All the companies are trying to manage this and make sure they get the headcount right, because that is a major expense for a lot of firms.
Brian, about a year ago, you were talking to us about the ramifications of AI and the explosion of efficiency. And you said that you think that headcount could remain about the same at the bank, even as the business continued to expand just in total size. I'm wondering if that's shifted, if you still see that as the natural progression of the relationship between the adoption of machine-based learning and the relationship to your headcount.
So there are two things now. One, I think the time we were talking, we were probably closer to 216, 17,000 people or 213,000. So I think we'll be managing this down. But remember, at the same time, we're managing out through operational excellence and efficiencies of applied technology. We are deploying. So we're adding, Wendy's added commercial bankers in all the markets, and Sharon and the team added business bankers in all the markets, and Katie and Lindsay and Eric adding financial advisors and private bankers. So we're adding front-end people, sales traders, et cetera, to keep building out our capabilities. And so there's a reinvestment going on. The key to that is really redeploying people and reskilling them. So when we bring these 2,000 plus teammates in who just joined us in the last month and a half, we have to be more mindful about training them along multiple dimensions than we might have been 2 or 3 years ago. So I think, yes, I think ultimately the human being content of our work product would probably come down. But if we manage it right, it'll be flat to the same amount of people, maybe down a little bit, but all paid more and all being applied to the highest value tasks where, frankly, the machines can't do the work. And that's the important thing. We know what this AI can do in today's world. Erica's been out there for 7 years, 3 billion customer interactions, 20 million customers using it all the time. We see what it could do. We took that and put it in our commercial business. We took that and put it in our internal process. We got other models to help in Jimmy DeMar's business in terms of a thing called Optimus and things like that. There's a lot out there, but what you're learning is there's still augmented intelligence, and that will be what's driving the near-term efficiencies. So yes, I think the headcount management is one of the core tasks that managers have to take seriously.
That is Bank of America CEO Brian Moynihan speaking there exclusively with our colleague Lisa Abramowitz. Let's have a check on how US assets are tracking futures. At least we didn't see a huge amount of reaction to that Fed decision. So perfectly had it been priced in. S&P futures, meanwhile, pointing higher by about 0.5% after that 25 basis point rate cut as expected. Tell you what wasn't expected, the rate cut from the Bank of Indonesia. We're keeping an eye on Indonesian assets after the country's central bank delivered that surprise interest rate cut. Bank Indonesia lowered that benchmark rate by 25 basis points. We're now down to 4.75%. That's its sixth easing since September last year. The move signals that the central bank is behind President Prabowo Subianto's bid to galvanize growth following widespread cost of living protests. Well, let's get a little bit more on the economic implications now with Radhika Rao, Executive Director and Senior Economist at DBS Bank. Radhika, thanks as always for joining us, and just want to start on that rate cut that no one saw coming, or two people saw it coming. Two of the 38 economists forecast that rate cut. Governor Wajiro saying it's all out pro-growth while maintaining stability. Is this rate cut going to achieve all those things?
Hi, Ellen. So the central bank, the last time they met, and BI tends to meet monthly, they did sound very dovish. So it was quite obvious that there were more cuts coming. I think it was a matter of timing. We were expecting the next cut in October. We thought, they would wait to see what the Fed does and then go ahead and lower rates. But, the cut was brought forward to September. And what you saw in their comments, what that underscores is that growth is becoming quite a big, policy objective. Earlier in the year, you had seen them weigh rupiah stability, for example, gave that a lot more weightage because inflation has broadly been, quite benign. But at this juncture, it does look like, their growth push is kind of coinciding with the government's pushes as well, where they've also undertaken or announced stimulus measures and also steps to infuse liquidity into the banking system.
Yeah, let's talk a little bit more about that interesting alignment. I mean, is that all it is, alignment between the central bank and the government, or is there any suggestion of political pressure here and that pressure being effective?
No, I would say that the new finance minister who took over earlier in the month, the markets are trying to pass through his, line of thinking, because obviously the previous finance minister gave a lot more weightage to austerity, maintaining within fiscal deficit targets. So the markets are still looking at what the finance minister has to say. And what we have seen in the initial days is that he is certainly leaning towards higher growth, doesn't mind loosening the purse strings, but again wants to stay with the fiscal consolidation path. As far as the BI is concerned, rate cuts have preceded the government's move. I mean, they've been cutting rates for a good part of this year. So they do have, from that angle, certainly on a dovish path. But I guess the scale that we had is more than what we had anticipated, and that perhaps is kind of coinciding again with what the government's objectives are. Because the second quarter growth numbers were quite strong. So acknowledgement that growth needs a bit more momentum is an official recognition that growth is in fact weaker than where their own forecasts are. So I would say that this is certainly a kind of a coordination between fiscal and monetary policy to be more growth as well as demand supportive second half of the year and going into 2026, because the BI is of the view that the output gap is still negative.
Very quickly, Radhika, do you have any concerns about inflation? Governor Wajiro seems quite relaxed about it.
Yes, certainly. I think the only component that we were tracking quite closely was food inflation, particularly rice. Retail as well as producer price indices for that commodity has risen. So that is feeding into food inflation. But that it didn't make much of a mention in the governor's comments seems to suggest that it's temporary. They'd see it as a supply side push and nothing that rates can actually do. So at this point, very much still benign. And I think our forecast is for about 2.2% this year. And about 4% next year. Again, much more of base effects. So certainly not a bit of a bother for the policymakers.
All right, Radhika Rao of DBS Bank, thanks so much for joining us. Well, President Trump has begun his UK visit with a lavish state dinner hosted by King Charles and attended by the CEOs of Apple, Citigroup, Nvidia and Blackstone. The real business, though, going to begin later on Thursday when the president meets with Prime Minister Keir Starmer. Joining us now is Bloomberg's chief Asia correspondent, Ros Matheson in London. So, Ros, what's going to be on the agenda when Trump and Starmer meet?
Well, as you were saying, day one was really about a lot of pomp and pageantry and making sure that, Donald Trump got literally the red carpet rolled out for him and a lot of time with the royal family. And so that was probably the easy part of the visit. The hard part may be today, of course, when he sits down with UK Prime Minister Keir Starmer, because so far they've been trying to keep things pretty light. They've been keeping it away from serious business. But we do know, there's been a lot of conversation about deals they can do to have US companies invest in the UK and get access also to the UK market. That's going to go quite smoothly, but there are a lot of other issues on the table, and when the two of them sit down, the question is, how do they come up? These are issues around trade. We know from our own reporting that the UK has quietly shelved plans to try and get Trump and the US to reduce tariffs on UK steel. That's going to go onto the back burner. There are also issues, obviously, around the Middle East. It's possible that Starmer will wait till Trump leaves, for example, to support an independent Palestinian state, so leaving maybe some of that harder stuff for further down the line.
And how about the conflict in Ukraine? Can we expect to see any movement there?
Well, exactly. That's also an issue that where the UK has been pushing strongly for the US to continue to support Ukraine, and with no obvious resolution in sight in Russia's war there, or any indication that Vladimir Putin is willing to sit down with the Ukrainian leader and hammer out some kind of end to that war. And you even saw King Charles, despite all the careful choreography yesterday, did mention at the dinner last night his understanding. He wanted everyone to support Ukraine, so he did get a mention in there. The real tricky thing is probably in the minute going to be more the Middle East and the question of Palestine, and whether Keir Starmer does mention that during their meeting today, or whether he opts to wait until Donald Trump leaves. It seems for now the Ukraine issue is very slightly on the back burner. Donald Trump is not indicating he's pushing hard on that either.
All right, Bloomberg Chief Asia correspondent Ros Matheson there. Before we go, here's a look at our guests for tomorrow. It is, of course, Bank of Japan Decision Day, with Governor Kuza Ueda's team expected to stay on hold. Morgan Stanley's Andrew Sliman is going to be joining us for analysis. Also, we'll talk with Urban Company CEO Abaraj Singh Bahl about their share price surge following yesterday's trading debut in Mumbai. They scored the best opening day for any Indian IPOs so far this year. That is it, though, for Insight. Horizons Middle East and Africa is up next. This is Bloomberg.